Welcome everybody. This is our Taxes and Retirement. Is your retirement safe from the Taxman presentation? I'm Greg Dillon, Managing Partner and Head of Retirement Income Planning and Wealth Management at One Team Financial. 37 pounds. That's how much my youngest daughter weighs. I know because I carried her all the way down. It was Labor Day weekend 2017, beautiful crisp weather in upstate New York. My brother-in-law suggests that we start the day out with a hike up to Catterskill Falls. And after about 30 seconds of internet research, I found that the trail was only about a half a mile in length and good for all skill levels. So off we went. This is a picture of my daughter Louisa and I about halfway up that trail. As you can see, we're looking a little tired at this juncture, but still smiles all around. Now, the descent from this picturesque waterfall was a very different story. For on the way down, I had to carry a 37-pound two-year-old who had decided she had had enough exercise for one day. Now, I like to consider myself a guy that's in decent shape, but there were times during this descent where I had to pass my daughter off to my wife, who was 29 weeks pregnant at the time. Not a particularly proud moment. But when we reached the flat ground, we all felt a sense of accomplishment. And that sense was further heightened as a group of serious climbers began to approach. These guys were decked out. They had the hydration sticks, the walking sticks, high-end hiking boots. I felt like saying, fellas. My two-year-old just climbed this trail. She was wearing a pair of Crocs and carrying two naked Barbie dolls. But I bit my tongue. Now, my journey up and down the trail that day isn't all that different from retirement. On the way up, we're working, we're saving, we're building up that proverbial nest egg. And on the way down, we switch from saver to spender, either because we need the money to fund our retirement lifestyle and our retirement dreams, or because the IRS is forcing us to pull money out of certain accounts. And as I learned from my hike that day, the descent is where things can get tricky, and retirement is no different. Unfortunately, many of the mistakes that we see people make as it relates to their taxes in retirement are irrevocable. But the good news is, a lot of these mistakes are completely avoidable. So today we're going to talk about three main topics. We're going to talk about today's tax landscape and some of the big changes that came about in the last decade. We'll talk about why taxes are different in retirement than they were during your working years. And lastly, we'll cover some of the common pitfalls and the frequent mistakes that we see retirees or pre-retirees make as it relates to their taxes. Now, after we cover these three main topics, there'll be two types of folks in the room. The first will say to themselves, I'm so lucky. My advisor's done me well. We've discussed all this and we've got a plan in place to deal with it. And you happen to fall into that camp, we'll congratulate you and hope that you picked up a thing or two in this presentation. But there'll also be a second group of folks that will say, I'm not quite certain we have this handled. And you might even wonder why some of the other financial professionals in your life have not even broached some of these subjects with you. And if you're in that camp, we're not going to leave you to fend for yourselves. Over the next 35 minutes, we'll help you to determine where you fall. And the last couple minutes, we'll talk about some limited opportunities to connect on your individual situation. So if we had a couple come into our office and say, hey, Greg and team, I'm making $44,000 a year, but I'm spending $61,000. Well, long before I get to do all the nerdy tax stuff and talk about tax mitigation strategies and asset allocation, clearly there's a problem that we have to address. You're spending more than you're making. But this isn't all that different than our government. If we look back at 2023, the government took in about $4 trillion in revenue, but they spent over $6 trillion, which is adding to a large and growing deficit. This is a truly terrifying site that you can feel welcome to peruse at your leisure, the usdebtclock.org. This is just a snapshot, but this will show you in real time the breakdown of our national debt. And one of the things that I look at is, okay, this national debt, it seems like a massive number. I don't even know how to put these trillions of dollars into context. But if I look at the debt per citizen, it's about 101,000. But the revenue per citizen is only about 14,000. So clearly this big national debt number is going to continue to move in the wrong direction. So what are the options? Well, the government really has two levers they can pull. They can reduce spending. Anyone think that the government's going to reduce spending anytime soon? Well, I would tend to agree that that's going to be very challenging because the lion's share of the federal budget is earmarked for social programs like Social Security and Medicare. And every day, 10,000 people in this country are turning 65, and they're going on to Medicare, and they're collecting Social Security, which is putting a further strain on the system. The other option, raise taxes. Now, some of you may have heard of FINRA. FINRA is a large regulatory body that governs most of the financial institutions that you do business with. And FINRA has a section on their website dedicated to retirement. The first sentence of that section reads as follows: when you retire, you leave behind many things: the daily grind, commuting, maybe even your old home. But one thing you keep is a tax bill. In fact, income taxes can be your single largest expense in retirement. Your single largest expense. And in our experience, very few people have a proactive plan to minimize that expense. So these are the tax brackets that we have today. On the right-hand side, we have married couples filing jointly, and on the left-hand side, we have single filers, right? So do we think today's rates are low or high from a historical perspective? Well, just to put it in context, long before he was president of the United States, Ronald Reagan was an actor. And in 1947, his Hollywood quote was $100,000 per film. Reagan only made 2 movies in 1947. Why? A third would have vaulted him into the top tax bracket, which at the time was 86%. He'd spend all this time getting into character, memorizing lines, all to keep 14 cents on the dollar. And the reality of the situation was the 14 cents wasn't even his. He lived in the state of California and also had to pay state income tax. So I'm not here to say that the top tax bracket's going up to 86%, but we do know that if Congress does nothing, which I would say is not outside of the realm of possibility, that today's tax rates, as passed by the Tax Cuts and Jobs Act, are set to expire at the end of 2025. So we really view now as a prime window of opportunity to do some proactive tax planning in an effort not only to minimize your tax bill in a given year, but also to minimize your lifetime tax bill. And it's important to note that not all money is taxed the same, right? We oftentimes hear people say, I'm in the 24% bracket or I'm in the 32% bracket. And they think that all of their income is taxed at that 24% or that 32%. Well, for a married couple filing jointly over age 65, your first roughly $32,000 of income is tax-free. Then the overage up to $23,000 of taxable income is taxed at 10%. Then the overage from $23,000 of taxable income to $94,000 is taxed at 12%, and so on and so forth, moving up the measuring cup. So one of the things that we look at is, and it's counterintuitive, should we be pouring some income into the measuring cup to take advantage of today's known low tax rates? And oftentimes, it makes sense to do so. So as we head into retirement, there are really 3 categories of accounts that we can have from a tax perspective. We've got our pre-tax accounts. Most common example is an IRA or a pre-tax 401k. The 401k can be a great vehicle while you're accumulating wealth because you get a tax deduction when you put the money in. But unfortunately, when you take the money out, that money is taxed as if you earned it in that particular year. It's taxed at the highest rates, ordinary income. And it's almost like having an adjustable rate mortgage on that 401k. You're going to be pulling that money out at some unknown future tax rate that could be higher or lower than the rates are today. The middle funnel here is the post-tax funnel. This is more of the tax me as I go. Certain instruments in here are more tax efficient than others. One incredibly tax inefficient vehicle is a bank account. So interest income is actually the worst income that you can have from a tax perspective, because interest income is taxed at the highest rates, ordinary income. Plus, if you earn over a certain amount, then you're also subject to what some people call the Obamacare tax or the net interest income tax. You layer on the state income tax on top of that, and some of our clients in these high tax states, they're not even keeping 50 cents on the dollar on the interest that they earn. But the bank account is an example of a post-tax account. Every year, your bank sends you a 1099. It says that you earned X amount of interest that year, and you've got to pay tax on that interest. The last funnel here is tax advantaged. So with the exception of the health savings account, there's no tax deduction when the money goes in, but if implemented properly, whether it's a Roth 401k or an IRA or cash value life insurance, if structured properly, when the money comes out, it's not even reported on your tax return. So a lot of folks talk about diversification. Do you have the right mix of stocks versus bonds versus cash? And that's important. But what's also important is, do you have the right mix of account types? Do you have some pre-tax, post-tax, and tax advantaged? Because if you do, then you can properly blend withdrawals from these different types of accounts in an effort to maximize your income and minimize your taxes. The charitable landscape has changed quite a bit over the course of the last 10 years, and the Tax Cuts and Jobs Act had a big impact on that. So the Tax Cuts and Jobs Act effectively doubled the standard deduction. Well, what the heck does that have to do with charitable giving? Well, it's estimated that only about 10% of the population now itemizes their deductions, and a much lower percentage of retirees itemize their deduction. Well, if you don't itemize your deduction, then you don't get any tax benefit of a gift of cash or check to your favorite charity. So some of the strategies that we look at would be bunching charitable gifts in a given year, qualified charitable distributions or QCDs, once you're 70 and a half, gifting money directly from your IRA to the charity of your choosing. And if reported properly and if implemented properly, it does not count as taxable income for you. And lastly, a donor advised fund, where we see folks transfer highly appreciated stock into a donor advised fund. The fund is a charitable vehicle, so it does not pay capital gains tax, so they avoid the capital gains tax on the highly appreciated stock. Now it's in the donor advised fund, and from that point forth, it can function like your charitable checkbook. In future years, you can write checks to the charity of your choosing in the amounts of your choosing moving forward. So one of the wrinkles that makes taxes different in retirement than they were during your working years is required minimum distributions. So the goalposts have changed a number of times. It was 70 and a half that you had to start taking money out of these pre-tax accounts. Then it was moved to 72 with the passage of Secure Act 1.0. Now it's 73 and age 75 if you're born after 1960. So one of the big mistakes that we see people make is they wait until the IRS is forcing them to take money out of these retirement accounts. But we view the ages between 59 and a half and 73 as really being the sweet spot for IRA planning, because during that window, there are no rules. You can take as much or as little out of your IRA accounts. Also, we may look at pulling some money out prior to Medicare, right? And we'll get into Medicare means testing. But Medicare looks back 2 years. So to determine your age 65 Medicare premium, they look your income at age 63. So before age 63, we can take money out of the IRAs and it doesn't have any impact on our future healthcare costs. So how do we figure out how much we have to take out? Well, in my simplistic example here, we're going to use round numbers to make the math easy for me. We're assuming that on December 31st of the prior year, the IRA account balance was $1 million. And we divide by some factor based on the IRS's table based on your age. So in that first year, you've got to pull out about 4% of your account balance and pay the tax whether you need the money or not. In each future year, the percentage that you have to take out increases. Now, some of the folks on the webinar may have heard of the 4% rule. For those that haven't, it's an old financial planning rule of thumb that essentially states I can take 4% out of my accounts in retirement and have a very low probability of running out of money. Now, some scholars have said that the 4% rule needs to be scaled back because of the recent low interest rate environment that we finally come out of. Others have said that market volatility means that we need to scale that back. Others have said 5% is a safe withdrawal rate. For our purposes, let's just assume the 4% rule holds. What's the problem with the 4% rule if most of my money is in pre-tax accounts? By the time I'm 78, I've already got to pull out more than 5%. By the time I'm 84, I've got to pull out more than 6%. And when you get to these advanced ages, the percentages that you have to pull out increase dramatically. If I make it to 93 in that particular year, I've got to take 10% of my pre-tax account balance out and pay the tax whether I need the money or not. It's exactly how the opposite of how most people that we speak to want to spend their money in retirement. Very few people say, well, you know, in the early years of retirement, we're going to scrimp, we're going to save, we're going to cut coupons. But when we're 93, we're going to travel the world. We're going to go hog wild. But that's how this is set up. It's a government program, and you've got to play by their rules. So this is one of the reasons that we look at potential strategic Roth conversions. And again, there are a number of factors that you have to weigh in terms of figuring out whether a shift from pre-tax or always taxed to Roth or never again taxed makes sense and the amount makes sense. But if implemented properly, that can be a powerful planning tool because Roth IRAs do not have required minimum distributions. Chances are at some point in your life, you're going to need a large chunk of money. Hopefully it's for something fun like a vacation with family or a wonderful trip or you know, the taking up the hobby that you never quite had the time to do during your working years. But it could also be for something not so fun, like healthcare. Well, if we start pulling money out of a pre-tax account in order to take a chunk out, right? If we need $100,000 as a one-time expense and we need to pull that from an IRA, well, depending on the other sources of income, we might need to pull 150 to net 100. But if we have money, a large and growing pool of money in Roth, well, we've cut the IRS out of the equation for that particular pool of money. If we need to net 100,000 from a Roth withdrawal down the road, all we have to do is pull out 100,000. IRAs are also terrible estate planning vehicles. They're the worst of both worlds. Number one, they're included in your taxable estate. And number two, it used to be that if I passed my IRA onto my daughters, they could take small distributions over their lifetime and stretch out the taxes over their lifetime. But in the words of Roberto Duran, no mas. Now if they inherit my IRA accounts, they've got 10 years in which to empty those accounts. And in all likelihood, that wealth transfer is going to take place during the kids' peak earning years. So they've got to take out that money each year and empty it in 10 years. and all that money that they take out is going to be added to their taxable income. And even under today's known low tax rates, a lot of that IRA could be lost to the IRS or to the state taxing authority, depending on where you live. So what do I have to do in order to trigger capital gains? The easy answer is I have to sell something. But there's one exception. This exception is specific to mutual funds held in non-retirement accounts. They can be subject to something called phantom gains. So the easiest way to talk about this is with an example. So let's just say this year I decide, you know what? I'm going to buy some shares of Mutual Fund A in my brokerage account, my non-retirement account. Well, over the course of the year, Mutual Fund A gets together, they look at their portfolio, and they've owned Apple stock since 1988. Obviously, it's had a heck of a run. But they say to themselves, you know what? For whatever reason, Apple no longer fits in our portfolio. So what do? They sell it. Why is that a problem for me? Well, even though I didn't participate in any of that run-up in Apple stock, I'm on the hook for the taxes because that tax liability gets spread out across current mutual fund shareholders. That's not particularly pleasant. But to add insult to injury, I'm going to put you in a time machine and I'm going to take you back to 2009. Now, what was going on in the US in 2009? Market crisis, mortgage meltdown, markets in free fall. Not the sophisticated investors on this webinar, but what did most people do? They panicked. They sold. They called their broker, they called their advisor, they said, I don't care what you have to do, get me out, sell, sell, sell. Now, why is this a problem for the mutual fund companies? Well, they've got to sell stuff, whatever they own, stocks or bonds, to raise cash to pay all the people that are leaving the fund. So I've always been taught you've got to invest for the long term, you've got to ride it out. But I got to tell you, at the end of 2009, I'm not feeling so hot. This mutual fund is down about a third and has lost a third of its value. Better than when it was down 50% halfway through the year, but still not so great. And then in February of 2010, I get a 1099, a little love letter from that mutual fund company that essentially states, well, Greg, we know you held the course and you didn't sell, but other people sold. So even though your fund has lost a third of its value, you also get stuck with a tax bill because we had to sell stuff to pay all those people that were leaving the fund. Mutual funds are great investment vehicles for instant diversification for small sums of money. They're fine in retirement accounts, but they can be incredibly tax inefficient when held outside of a retirement account. Tax-sensitive allocation. What a fun thing to talk about. What this boils down to, it's not just about what you own, but it's about where you own it. There are certain types of investments that are best held in a retirement account because of their tax characteristics. There are other types of investments that are best held in a non-retirement account because of their tax characteristics. And knowing what to own where can have a massive impact on your current and future tax bills. And look how happy everyone is if we can get this right. Wonderful day. So Ash Alawalia is our Social Security specialist. He's very well versed in the topic of Social Security. He's spoken at CPA firms and law firms all across the state and country, and he's a sought-after speaker. The only reason that I put Social Security up on this slide is because Social Security is nuanced from a tax perspective. If Social Security was the only item that you had on your tax return, your tax bill would be zero. It's all of your other forms of income that make Social Security taxable. So to figure out how much of your income from Social Security is taxable, we take half of your Social Security benefit for the year, plus your ordinary income. This could be interest, this could be IRA withdrawals, plus your dividends and capital gains, plus municipal bond interest, which is normally tax-free, but does have an impact on the taxation of your Social Security. And if that number of provisional income is above $25,000 for a married couple, 50% of your Social Security will be included in your taxable income, If it's above $34,000, 85% of your Social Security will be included in your taxable income. So for most folks, 85% of their Social Security will be taxable in whatever bracket they happen to fall into. And the good news is that we've finally got some bipartisan agreement. We can thank the Reagan administration for the 50% threshold, the Clinton administration for 85% threshold, taking back Social Security dollars that you've already been taxed on in the first place. What a system. Sadly, one of the things that we see people fail to plan for is the death of a spouse, right? So we've got a simplistic example here. We've got John and Sally. They have modest income needs. They're living on $60,000 a year. John's collecting $20,000 from Social Security. Sally's collecting $10,000, and they're pulling $30,000 from their IRA account. When they're both alive, their federal tax bill is just shy of $1,000. But sadly, Sally predeceases John. And now in the year after death, he has to file as a single earner. The Social Security goes down because Sally's check goes away. John keeps his because he has the higher of the two checks. So now, in order to plug that income gap from the missing $10,000 from Social Security, John pulls a seemingly harmless extra $10,000 from the IRA account. You can see the exact same income of $60,000. But because of the makeup of that income, and because John now has to file as a single individual, his taxes have skyrocketed. His bill goes from shy of $1,000 to $5,300. So when we talk about legacy, we're not just talking about the legacy for the kids or for charitable organizations, but also legacy for that surviving spouse to guard against this, what we refer to as the widow or widower's penalty from a tax perspective. Because we almost always see income go down, but a lot of time taxes go up, and they can go way up. So again, I alluded to this earlier, Medicare is means tested. What you pay for your health insurance in retirement is predicated on your income in retirement. So if I have a couple earning $150,000 a year in retirement, their Part B premium is going to be about $2,000, and they're going to pay whatever the plan cost is for their drug plan. But if they're at $260,000 of income, their Part B premium is effectively doubled, and they're going to pay another $400 for their drug plan. Now that might not seem like a big deal today, but Medicare is in pretty bad shape financially. There's 10,000 people a day that are turning 65 and going on to Medicare, and there's far fewer workers that are paying into the system than were when the baby boomers were working. So it's possible that over time these brackets will get compressed and these surcharges will increase to keep Medicare afloat. And again, this income is basically factoring in all of the income that you can think of: IRA withdrawals, pensions, Social Security income, doesn't take into account Roth IRAs, doesn't take into account distributions from cash value life insurance. So this is our tax map. These red bars, as we move from left to right across the income spectrum, are intuitively what we would expect to lose to the IRS as a result of taxes. But we're going to learn that how this works in real life is far from intuitive. So we've got John and Jane. The names have been changed to protect the innocent. Married, filing jointly. They're over 65. Their combined Social Security is $60,000 a year. They have $15,000 of net long-term capital gains and $45,000 in combined required minimum distributions, or RMDs. So again, the red is our tax map. That's what we would intuitively think that they would be losing to taxes. The gray is their actual tax experience. You can see that these people never experienced the 10 or the 12% bracket. And at only about $50,000 of income, they lost almost 50% to the IRS. And I say, how the heck does that happen? Well, what do we think should happen? If we have a married couple and they're $50,000 of income so far, they pull $1,000 out of an IRA, they're in the 12% tax bracket, 1,000 times 12%, $120 in tax. And that does happen. But that seemingly harmless IRA withdrawal also causes $850 of Social Security to become taxable at 12%, which in turn causes $1,850 of capital gains to become taxable at 15%. So all in all, they pulled $1,000 out of their IRA account and only $500 of it made its way to their pocket. This is one of the reasons that we believe that you should have a proactive strategy as it relates to taxes. You can't just pull money willy-nilly from accounts in retirement without understanding the impact on your bottom line. People talk all the time about inflation, and inflation is a big deal because that's an assault on your purchasing power. But so are taxes. That $500,000 is lost to taxes will never earn again, right? So if we can minimize and reduce the tax drag on our income and our investments, that's more money that we can spend, that our families can spend. And I've yet to meet a person that says they believe that the bureaucrats in DC can spend their money better than they can. So this is that tax map as it relates to capital gains. At about $20,000 in capital gains, this person was set to lose a third of that capital gain to taxes. Now, don't you think you'd want to be armed with this information before you sold a stock or a bond or a fund? But most people just take the action and deal with the consequences when they file their return. So sequence of return risk. This is a critical risk that we need to address. It's a risk that you've never had to worry about when you're in the accumulation phase and you're building up that proverbial nest egg. It's a risk that's unique to retirees or people that are pulling money from an account. So here we've got two boxes with two different retirees. We've got Ms. Happy and we've got Mr. Unhappy. They both have $1 million. They both average a 6% rate of return. And they're in that accumulation phase, so they're not taking any money out. The only difference between these two folks is that for Ms. Happy, we put the positive returns on the front end and the negative returns on the tail end. For Mr. Unhappy, we just flipped it so that the negative returns are on the front end and the positive returns are on the tail end. Now, if you compare the ending value in any given year, you see that they took two very different paths. But at the end of 10 years, they both wound up in the exact same spot. While you're working and saving, sequence of return risk is inconsequential. To determine how much you're going to accumulate, it's a matter of how much you're saving and what is your average rate of return during that time period. But once we get into retirement or the journey down the mountain, then the game changes significantly. So here we've got the same two folks, both have the exact same amount of money, $1 million, could be 10 million, could be 100 million. The concept's exactly the same. Both averaging a 6% rate of return. The only difference between this slide and the previous slide is now they're pulling out $60,000 a year to supplement their retirement. So again, Ms. Happy, she had the great returns up front, the negative returns on the tail end. At the end of 10 years, she wound up with more money than she started with, and she took out $600,000 over that 10-year period. $60,000 a year times 10 years. Mr. Unhappy, again, we put the negative returns up front, the positive returns on the tail end, the exact same amount of money, the exact same 6% rate of return, but he wound up in a very different spot. If you look in the lower right-hand corner, he's down to about a third of what he started with. So the moral of the story here is that when you're in retirement, it's the average rate of return that is almost inconsequential. What's far more important is when you get those returns. It's dumb luck, right? No one has the crystal ball. And if you hear someone say that they do, run, don't walk away. So how do we guard against this risk? I'm glad you asked. We utilize a philosophy called the bucket plan, and it's simple and easy to follow. you've got your now bucket. That's your cash in the bank, your comfort fund, your emergency fund, and any planned expenses for the next 18 months. We know that it's not earning a heck of a lot in the bank, but it's there to give you peace of mind, and it's there to be reliable income for that first year of retirement. So we've bought a time horizon with 1 year with the now bucket. The soon bucket is really designed to fund years 2 through 10. And you don't want the soon bucket invested in something that's going to have huge fluctuations, because if you happen to time it wrong and you're taking money out to fund your retirement lifestyle at the same time the market's going down and it's taking money out, then you're burning the candle at both ends, and it's difficult to recover from that. Ask anyone that retired in 2008 or 2001, right before the tech crisis or right before the mortgage meltdown. But if we've properly segmented the now bucket and the soon bucket, well, even though we're approaching retirement or in retirement, we've effectively bought ourselves a time horizon, and we can continue to invest the rest of the money in the later bucket with a tilt towards growth, knowing that we're not going to be in a position where we're forced to sell low, right? We've bought ourselves a time horizon so we can allow the market to grow in the later bucket, right? We know that markets go up over time. We just don't know when and by how much, and we don't want to bank on the market to fund our early years of retirement, right? We believe so strongly in this concept, we actually co-authored a book with a group of like-minded advisors that takes a real-life couple through this process. And again, we think it's a fantastic way to segment money by time and by purpose, and it's a way that folks can understand. So we talked a lot about the problems with taxes in retirement. What are some of the solutions? Number one, diversifications among account type, right? Do we have the pre-tax, the post-tax, the tax advantaged? And if so, then we can properly blend withdrawals from those accounts in an effort to minimize our taxes and maximize our income. In some cases, it does make sense to defer taxes or delay taxes, particularly if you have a business owner that just sold their business, they had a liquidity event. That's an example of a year where we're going to look for as many deductions as possible. Conversely, if we have a retiree that in their first year of retirement, they're just planning to live on their savings, well, there's a lot of different tax planning tools that we can use, not only to help them minimize their taxes that year, but to minimize their lifetime tax bill. And the last one is asset location. It's not just about what you own, but about where you own it. Certain types of investments are best held in retirement accounts because of their tax characteristics. Other types of investments are best held in non-retirement accounts. And we look at tax returns all the time and investment statements, and we see that although the overall mix of investments might not be too out of whack, oftentimes the things that are owned in the wrong types of accounts. So if you'd like to learn a little bit more about the bucket plan philosophy, feel welcome to let Gina know. We can send you a copy of our book or a copy of the ebook. And again, we find that this philosophy gives people peace of mind, which is something that most of the retirees that we meet with are desperately seeking. So I'll leave you with this. My youngest daughter was a bit of a handful. For the first 6 months of her life, we were afraid to leave the house. We were fearful that her screams might wake the dead. Now, one night during this sleep-deprived stretch, I get home from work late, and my wife informs me that there's a small puddle in the basement. Call someone, she says. It was a busy time in our lives. We were both exhausted, and dealing with this seemingly trivial issue was not a top concern. So what do? We ignored it. 2 weeks later, we finally summoned the courage to leave the house as a family. I walked down to the basement to grab some of the baby gear, only to discover the entire basement floor is covered in water. What could have been an easy fix ended up breaking the bank. And worst of all, I had to admit to my wife that she was right all along. Now, here's what I know to be true. It's far easier and less expensive to address a small problem than to wait until it turns into a much larger issue. Now, some of you might have some minor leaks in your retirement income plan. Maybe some overlap amongst accounts. Maybe some future tax issues lurking. You can do what I did with the puddle, and you can ignore those problems and hope they go away, or you can start to chip away at some of those small problems before it turns into a flood of issues. We welcome the opportunity to chat with you about your specific situation and see if we can be helpful in helping you navigate this next phase of your lives. Thank you.